Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we're going to learn a concept which is known as capital reserve. Just like in warehouse, there is goods that have been stored. In the similar fashion, every company has a warehouse where they keep their profits, amount of the profits in terms of reserves. There can be different types of reserves: revenue reserves, capital reserves, revaluation reserves. So every reserve have their own importance, and it has been organized, or it has actually been placed for their respective functions. Let's understand this one. That's your capital reserve. Let's see what's written in the dialog box. Capital reserve is basically an account on the balance sheet to prepare the company for any unforeseen events. It's like for any contingent events or for any uncertain events like inflation, instability, needs to expand the business or to get into new or urgent projects. So basically, to deal with any contingent activities, capital reserves is actually used for the particular activity that has to be conducted. Let's understand this thing in a complete detailed format. What we are discussing, as I told you, reserves are of different types. I'll give you a few examples. Revenue reserves, then we have capital reserves, which we are discussing. We have revaluation reserve, right? So these are the couple of examples through which one can understand reserves. What is it? What's the importance? Now, as far as the capital reserves are concerned, in our case, we are going to deal with this with the help of an example over here. See, as an example, we can talk about profit on sale of fixed assets, or I would say profit on sale of shares. So these are the two examples that one can work with when we are talking about capital reserves. Now, remember one thing, it works in a quite a different way when a company, sells off its assets and makes a profit over here. Then a company can transfer the amount into capital reserve. So in this kind of activity, the amount can be transferred to the capital reserves. Since a company sells many of its assets and the shares, in that scenario, and cannot always make profit in this particular scenario, shares and assets, because sometimes you may make loss. So it is used to mitigate or hedge basically any capital losses, even, or any other long-term contingencies. So this reserves has been used for this particular reasons. It has nothing to do with the trading and the operational activities that the business that have been conducted. So it is created out of all the non-trading you can say that activities, and thus capital reserve can never be an indicator of operational efficiency. Remember one thing of the business, because over here it is created out of the non-trading activities, and that's why it is not an operational efficiency benchmark. Another thing that is really very important and significant in nature, that it is not always received in monetary terms. If we are talking about capital reserve, it is not always received in monetary value or terms, but it is always existent in the book, in the books of accounts, you can say, always, of the business. So in terms of cash, not sure, but yes, in the books, yes, it is there. Let's take a few more examples of capital reserves to get more insight of the same. Now, instead of taking a business perspective, let's first consider an individual perspective. An individual perspective, let's say that you would like to buy a land in future. So you begin to set aside some money, right? Like sell off old stuff at your home or sell off your old car. This can be all the reasons you have, and set aside some money from your income. And you create a thing called one saving account. Let's say you created a saving account to save all the money that you have gathered for the new land, and you're not entitled to do anything with that money other than buying the land for yourself in future. So that amount has to be significantly or strictly used for buying a land. Now let's extend the similar example to a business. If a company decides to build, let's say, a new office building, they need capital, and they don't want a loan on a huge amount of from outside, loan from outside, as you know the cost of capital can increase, and in that case it would be really very huge. So they plan to build a new building by creating a capital reserve, and they decide to sell off their lands and their old assets, right, of the company, and then the money received from the transaction is transferred to the capital reserves. So it's like, let's say you sold off, there is a sale of land over here, and you got closely to $4 million. Everything is in million, and you sold off your, there was a sale of your shares, and from that you received, let's say, 10 million. So in total you have 14 million. You sold off this your shares and land for one specific reason, because you wanted to build a new office building. It's going to be, let's say, a 14-story building. So you're going to utilize this 14 million to build that building. So we'll transfer this to your capital reserve for specific activity. The money received from this transactions is transferred to the capital reserve, and since the company is not entitled to pay any dividend to the shareholders out of their reserves, they can use their amount for building a new office building for the company. We have by far now understood the examples of capital reserve. Let's understand the exception. See, sometimes it is not created for any particular long-term projects, or rather, when a company feels that they need to be prepared for any economic, you can say, instability or inflation or recession, or cutthroat competition, then in that scenario they can set aside some money from their profits, and they make a selling of their assets or land or whatever may be the case from purchasing a small company, and create a reserve for the particular reason. Now, capital reserve accounting can also be used for mitigating any capital losses. Now, since the profit of from the sale of the asset, I'll write for you, profit from the sale of the asset, or are not always received in terms of monetary value, which we know very well. So they are caught in the books of accounts, and it is similar with the losses on the sale of assets. So using the capital reserve, the company can set off the capital losses also. Right. So, based on our discussion of all of this content, it's clear that capital reserve accounting is a great source for financing any long-term projects, and a company which isn't very keen to do funding from the external source like debt, term loan, and so on and so forth can use this kind of reserves to fully finance their new projects. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.